Hey everyone, my name is Daniel and I'm here with Ashraf from Silicon Valley Bank and Andrew from Clearco. And we're super excited to bring you our follow-up to the conversation between Ashraf and Michelle, a few months back when we launched the partnership. And so today we're kind of revisiting where Clearco has gone since then, and lots has gone on in the world since then. So really, I'll just leave it to you, Ashraf and Andrew, to take us from here. So thanks everyone for tuning in.
Thanks, Daniel.
Thanks, Daniel.
I love the intro. It's pretty cool, Andrew. Good job on the marketing team over there.
Our creative team had a lot of fun with this. They were having a blast and got some good stuff there. Are you getting feedback? I'm getting a little bit of feedback on my end.
I'm not getting a whole lot on my end.
Okay.
But I could. Let's just try. Let's not take any risks.
Let's not take any risks for the people.
And make sure that I'm not doing it in any injustice.
No worries. It seems like it's okay now. So, let's give it a shot.
How about now? Is that better?
Yeah, I think that's much better.
Hey.
I'm saying our marketing team had a lot of fun with the rebrand. They enjoyed it, and we created a good dynamic there.
That's awesome. That's great. Well, thanks for making the time. I know that we probably don't have a whole lot of time together, but I would love to just first and foremost, I loved asking Michelle about her founder story, and I think maybe not everybody that's listening in knows the founder story, your founder story, and how you came to co-found Clearco with Michelle. So if you don't mind, I'd love if you don't mind sharing.
Yeah, absolutely. So I'm an engineer. I'm an immigrant. Was born in India. Lived in Chicago for a few years and grew up outside of Toronto. But studied engineering and worked in strategy consulting for a couple of years and realized I'm much more of an engineer and a builder than I ever was going to be a consultant or big company executive. And met a guy named Chamath, who was a fellow Canadian immigrant Waterloo grad. So we had a lot in common. So he convinced me to move out to Silicon Valley, and I think that was almost 10 years ago, more than 10 years ago, actually, 2010. That was probably what opened my eyes to just how different the opportunities were for founders that were in Silicon Valley that had graduated Stanford or grew up in the Bay Area or had good connections, compared to my friends back in Canada that were starting businesses, or my friends in Europe or India or anywhere else in the world. And I think that was a big part of my motivation, was just this idea that talent, ambition, work ethic are global, right? And they're sort of universally distributed, but opportunity is not. And so a big part of my career from that point on had been helping to increase access to, initially access to capital and then overall opportunity in other parts of the world. So I moved back to Canada. I built a couple of startups, and I joined a couple of startups, and a big part of my role was to help them fundraise. And so, I moved back to Canada, and they were like, "Can you get back on a plane and go back to the Valley and raise us a Series A or Series B?" So I did that a few times, and that's how I actually met Michelle. She was raising money for her company, and so somebody introduced us, and I gave her some pointers and made some introductions, and at one point, we started talking about what was next and what to build. And ironically, we talked about raising our own venture fund and realized sort of the world didn't need another venture fund. But we sort of realized that we could use technology to do this at a much, much bigger scale.
That's awesome. So, I'm gonna surf as much as I can, make sure I'm well schooled in some of the folks I get to talk to. And one of those things that you played an active role in, I don't know if you co-founded it, but was Wealthsimple. And so I'd love to understand, was there any continuity in sort of what you learned at Wealthsimple, what it was, what you learned there that you then parlayed into Clearco? Extemporaneous question, but I'd love to know.
Yeah, no, I wasn't a co-founder. I was a seed investor. Mike Katchen and I worked at McKinsey together, and he was a very, very good friend. We both lived in the Valley at the same time. And then we both moved back to Toronto around the same time. So Mike at Wealthsimple was a close friend. I was an early investor in their company. And I think, I saw, he was one of those guys I invested in regardless of what he did. And I saw the success that they were having, and it sort of opened my eyes to the opportunity and the need for fintech and financial services and sort of digitally enabled financial services. And so that was sort of, I realized fintech was an exciting and high growth area. And then I realized, what I really cared about was helping entrepreneurs and helping founders win. And so married those two, where he said, okay, well, how do we build better financial services for this sort of next generation of new economy entrepreneurs and founders?
That's awesome. One of the things that obviously for me as the head of startup banking that I really loved about engaging with Clearco was you were doing it differently. And you mentioned like maybe the world doesn't need another VC and let's do something differently. And you've taken a more of a non-dilutive approach to access to capital. Can you talk to us a little bit about the decision to do that and why such a strong focus on the non-dilutive capital sources and maybe just speak to it also at that early stage?
Yeah, there's a few reasons. So, a personal reason, I think throughout my career prior to starting Clearco, I had seen all the benefits of having venture capital. Michelle had only bootstrapped her previous company. So she, hadn't raised outside capital, given up ownership control, but I'd also seen some of the downsides. So, it was interesting for those that don't know, Michelle and I are dating in a relationship. So we started dating probably 4 months before we started the company. And then I actually, with my last business, we ran a very fast, fundraising process. We had something like 6 weeks of capital left, and we needed to make, a number. And so, ran a really fast fundraising process, raised some funds, but gave up probably too much ownership and control of the business. And so, when we missed a target, the new investors kind of came in and said, "Well, we're going to bring in our own people." And so they've sort of like completely cleaned house and brought in their own team. And I sort of saw the other side of the sword of, you give up ownership and control too early to your business, and it's not your business anymore. You kind of work for somebody. And so that was a big part of my mission and motivation. I remember coming home that day and being like, "Oh, Michelle, I don't think I have a job anymore." She's like, "Okay, that's great. We're going to go start a company." And so that was definitely encouraging. I don't think I would have started that without her encouragement. But, I think one of the things that I've realized is there's an important place for venture capital and equity in many companies. Every company goes through this point where you're investing in the high risk, high leverage, moments of your business. You're building a new product. You're trying to find product market fit. You're testing a new channel. You're testing a new market. You're not sure if it's going to work. So this new experiment could be wildly successful or could fail completely. And that's a great use of equity. But as you develop your businesses, as you start to figure, even in the early stages, you're like, well, this channel is working. I put $1 in, I get more than $1 out. There's some predictability and repeatability to it, whether that's on in marketing, whether that's on inventory or infrastructure on the side or salespeople. You get some predictability in your business, and then equity and venture starts to feel expensive for those parts of the businesses and puts you on a specific path. And so there's a whole ton of businesses that might have been incredibly successful, but they were capitalized in the wrong way and they gave up too much ownership and control. And so the only opportunity was to try and grow, unnaturally fast. And they died trying to do it. And so, I think that's where giving founders an alternative in capitalizing the lower risk parts of their business to preserve their equity to fund the higher risk experiments, felt like an important part of the puzzle.
Yeah, I love that. And it's amazing, right? Because at the early stage, I'd say typically and archetypally, you'd think that, really raising capital is almost synonymous with equity, right? And I think in many ways, you're changing that conversation. It's the reason why we were so attracted to the partnership, because Silicon Valley Bank also is not only thinking about equity as a capital structure. It's obviously incredibly welcome. It's got its place. It's incredibly important. It's a big part of the success of the asset class and tech and life science companies, but there's other parts of that capital structure that are important. So obviously couldn't agree with you more. If you don't mind switching gears, and you could just tell me when you want me to stop asking the question. It's got a lot of them, so you let me know. But asking you a little bit about the name, we've been talking about it was ClearBank.
Yeah.
You left us behind a little bit with Silicon Valley Bank. I thought we were going to stay friends, but you went Clearco on me. So I'd be curious to know what was the impetus behind it. I'm sure incredibly well thought out, but I know a little bit of the story, but it'd be great, I think, for the audience to hear it as well.
Yeah, I think one thing we started to realize is, people were certainly coming to us for capital, and that was what we did. But increasingly, they were founders were asking us for help on what to do with that capital and how to deploy that capital most efficiently, what to spend, how to which agencies they should use, which how they should plan their inventory purchases, which pieces of software they should buy, and so we started to see our role as much more of like a longer term partner, and not just sort of a capital provider. And so I think we realized that we wanted to be and for better or worse, and you guys have certainly been able to create relationships, like longer term relationships, with your clients. But we found as a more of a startup, people associated bank with we'll come to you when we need money, and increasingly we wanted to say, well, we do much more than that. And you can come to us even if you don't need money, and we can still give you advice and insights. And we've got an ecosystem and a set of partners and recommendations we can provide. And so, shifting that, because we're not a bank, taking that out of our name provided a little bit more clarity and a little bit more breadth in the types of product offerings that we could, bring to market.
Yeah, and that's, again, I mentioned that to Michelle on the last conversation we had. That was the other thing that I think really attracted Silicon Valley Bank to the partnership, is that you are thinking beyond a singular product. You are thinking about the founder's journey, from soup to nuts, and I think that's really, really important. And we think the same way. I think Silicon Valley Bank tends to be thought about as a deposit-taking, debt-providing business, but in reality, it's far bigger than that, right? I mean, we've got, and all this stuff obviously is public information. You've got a private bank, you've got a fund of funds business, so we're an investment manager, right? We do direct investments as well, and SVB Capital. We've got a bunch of different products, and so we're continuing to innovate on our end, and we wanted to be with a partner that we knew was front and center around innovation as well in financial services, and I think that's a lot of the reason why it made sense from our angle. But I'd love to hear from you, if you don't mind, what made sense to you? I asked that of Michelle. I'd love to hear it from you as well.
Yeah, I mean, we fund online businesses, right? Like, we've always thought about partnering with online businesses because those are the types of businesses we know how to help. And when we looked at, who the right partner would be, that banks, the majority of online businesses, it was obvious that Silicon Valley Bank, you guys have made a business around funding internet businesses and online businesses, and or banking internet and online businesses. And I think that was where, Silicon Valley Bank has always been sort of at that forefront of innovation, right? Where other banks have struggled with, well, what do you do with a business without assets, without equipment and real estate and buildings and tangible assets? And Silicon Valley Bank has always been able to help understand those businesses, take a different approach to understanding the value in these companies and helping them grow. And that's where we always, that was where we saw a real opportunity to partner and help, because you also know you are a bank, and so you don't have credit products for every customer and every that you have banking products for, and that's where we can step in and help, given the different ways that we're able to look at things.
Yeah, I agree. I think your focus on that early stage felt really right to us, in the sense that it's not that we're not doing lending at the early stage. Of course we are, but there's a lot more companies out there than we could serve as one singular bank sometimes. And I think having the right partners to go after a like-minded mission, to provide access to capital to those that need it, that are going to be the future of the economy, not the innovation economy, the future of the economy, right? Innovation has truly gone horizontal, and we need as many like-minded players in the space. And I think Clearco is a clear leader there. And I do think that you coming in at that sort of early stage, giving that access to that capital up front, and then us coming in with that growth stage, at that scaling position, when the company is ready to scale, really fulfills the end-to-end mission. I think that you and Michelle and I and many others in both of our companies really felt was important to the founders. Really putting the founders first, putting the companies of the founders first, and understanding the complete journey and where capital infusion becomes important. And I think we had our strengths to hold that out, and it made sense. So that's awesome.
Yeah.
You know, I mentioned SVB Capital on our side, on the investment manager side. You know, also since we talked with Michelle a couple of months ago, you've been innovating, and so maybe there's a little bit you might want to talk to us about Clearangel. I know that there's some really exciting stuff there. Would love to hear about, you know, what was the impetus for it, traction you're getting, what do you see in the future of it?
Yeah, no, we're incredibly excited about that product. You know, that the history is, you know, we looked at our data, we funded 5,000 businesses, but we said no to 50,000 because they were too small, too early, too unpredictable. And we looked at it and realized we could actually help most of them actually get their business in a position where they qualified for our capital, and then they qualify for your capital. And so we tried this thing where we used our data to build a playbook. And we say, look, if you're an e-commerce or a SaaS founder, we know, and you're just getting started and you've got your first couple $1,000s of revenue, but you haven't really figured out how to scale that, we can help you scale. And we can give you the playbook, and we can actually make an investment. And we sort of treat it, you know, it's our version of a Y Combinator or Techstars accelerator, but instead of it being hey, you know, 3 months and then you do a demo day and then you raise a, you know, seed round, it's a 4-year program. And we basically say, look, we're going to make an investment up front. We'll have a 2% rev share, so it's still non-dilutive, and we'll do that for 4 years. And so our goal is to take you from a few $1,000s of revenue to hundreds of thousands or millions of dollars, because that's the only way the economics work for us. But it, you know, it's been working incredibly well, because a lot of founders, you know, especially in different parts of the country that don't come from, you know, the right networks, they don't have a friend that has been through Y Combinator, for example, you know, or a network, they don't know how to get access to those products, or they may not want to be on the venture path where they're like, look, I'm gonna do this and then raise the round and then do that again, you know, every 6 or 8 months, and they may want to build a more sustainable business, or they want to, but they may just not have access to it. So that's really what we're building is, you know, a longer term accelerator. We think of us as an advisor, sort of board member, without the control, but where we make the investment, we put skin in the game, and then we pair you up with a coach, and you know, give you access to our network and our ecosystem to give you that leg up that you would get from a, you know, an accelerator program or a Shark Tank type angel investor that many people are looking for.
Not that you have any affinity to a Shark Tank program or anything, you know, not at all. No, it makes sense. How should a prospective client think about Clearangel relative to the Clearco program? Is it additive? Is it complementary? How's it different? Is it size? Just as they're sort of evaluating which entry path into Clearco makes sense to them.
Yeah, so Clearangel is really designed to help you. You know, it's much more if you're looking for a partner, you're looking for kind of a coach or mentor to kind of work with you over the long term. And it's really designed to build repeatability into your business model so that you can effectively take advantage of our other capital products. So if you think about our marketing capital or inventory capital, those are designed for, I know I put $1 in and I get more than $1 out. And so, you know, you typically, you know, and our average fee is 6%, you know, duration is 6 to 8 months. And so if you know that you can make more than, you know, you can double your money in that period of time, then it's kind of a no-brainer. And so that's sort of that's the core, you know, Clearco capital products. Clearangel is designed for companies that are trying to get there, where they may not have the repeatability. Maybe some months or some seasons, you know, they try a new channel and it works, but then the next month they don't have that. And so we work with them, we partner with them to build and design that repeatability and discover that repeatability in their business, so that then they can take advantage of the rest of the capital products as they continue to grow.
Yeah, that makes a lot of sense. And I think, again, like if you think about Clearangel, you think about Clearco, then you think about SVB as with the partnership perspective, you really are, and we are together, I think, really holding out a lot of that. I'd say the the banking and financial services journey for an early stage, because I think about your side and I think, okay, great, access to capital super early. On our side, it's free banking services, no footnotes, right? I mean, it is come in, get bank account for free, no fee, no hidden fees, a charge card. We've got an innovators card with amazing rewards, discounts, and servicing on our side to like really love these clients. You too also have that. Yep. You also have your discounts. So I just think we're really we're trying to make it frictionless, frankly. And I do like that, because this isn't really the time, I think, to like nickel and dime a startup. Like that's when they need the money. Like there's going to be a time and a place to monetize. And that's when they grow up and they mature and they've got more capital and they have the ability to actually have that leeway financially. But early innings, it's not the time. So I love that you're doing that. Question on like international expansion. I know we sort of started, let's focus on some core geographies, but it's been getting interesting lately. So I'd love to just hear a little bit more about your geographic strategy. Would be awesome.
Yeah, well, I started talking about, my own journey, and probably one of my biggest realizations was that in every corner of the world, there is entrepreneurial energy, right? There are founders who want to see the world look a bit different. They see a problem, they see an opportunity, they see a way to apply their skills to make a difference. And one of the biggest challenges is there's, the access to that opportunity, the access to expertise, the access to capital is not evenly distributed. And so if those founders are not able to or not willing to sort of get up and move to a major city, right, or a major financial center, really, Silicon Valley or New York or London or Tokyo or whatever, then they may not have the opportunity to make the impact that they otherwise would have. And we feel like in today's world, where we can actually use technology to reach almost every founder in the world, we should be able to do a better job. And that's really our objective. And so it's a big part of the reason why we raised a Series C earlier this year to really focus on our international expansion, and bring this offering to founders in every corner of the world. And so you've seen us launch a couple of European countries. We'll start to continue to look at Asia and Latin America throughout the year, because we just see a ton of great entrepreneurial energy and need for our products and services.
That's great. It's really kind of cool because SVB also believes in the international scene, right? I mean, we have a presence, and by presence, I'm not saying physical offices everywhere, but in a lot of these we do, right? And we're operating a significant banking business in some of these areas. But broad speaking, we've got a presence in multiple areas, and through a JV in China, we're in the UK, we're in Germany, we've got a presence in Canada. Yep. We're really all over in the places that we don't have a physical presence, we're engaged in, right? We're in MENA, we're in Latin America. And it's so refreshing to see when I mentioned innovation has gone horizontal from a sector perspective, it's gone horizontal from an international perspective. And I think the types of attributes that you see in the international markets around resilience coming from more macroeconomically challenged countries and what that does to innovator behavior is so amazing. So I think the sooner we can provide financial services to the rest of the world, I think the better we can allow innovation to thrive globally. And I just love that. I think we're both playing a role in trying to make that happen. So that's awesome. I see a question popped up. Do you want to take it or?
Yeah, I can talk a little bit about this. So this is one of the things, it wasn't actually something that we actively tried to do, but we found that because you don't need a warm introduction to us, because it's not a relationship-based sort of transaction, it's much more, if you bring the data, then we can come up with an offer for you. We were able to really sort of reshape the portfolio. And so, I think we fund something like 8 times more women than a typical VC. 30% of our founders are people of color. We've got founders in every state in America. When we launched the UK, 70% of the founders were outside of the London area. And so, from a geographic diversity, from a gender and ethnic diversity, we actually had a much more diverse group of founders that we were able to back, and that means that they're building products for different segments, right? So we had people that are building products for autistic children, or people with specific skin conditions, or like specific health conditions. And so I think those products may not have been typically funded by a VC who can't relate to those problems, but those founders had, they really understood the problem. They understood how to reach their customer bases in a profitable way, and they had solid businesses that we could invest behind, and we could see it in the data. And so I think that's going to be the exciting part. Is many of these products may not have seen the light of day if we didn't have an automated underwriting process.
Yeah, I totally agree with you, and I do think I do think that it's some folks say this opens up the opportunity for new businesses and ideas to be created by those that have been underserved. And I look at it very differently, which is those ideas are already there.
Mm-hmm.
It's just a matter of seeing it and going after it. But they don't need, the underserved community doesn't need permission to go have ideas. They already have them. It's just about banking them. And I think what's amazing is these are amazing ideas that are incredibly bankable, incredibly investable. And I'm just so glad to hear you think about it that way. I think another question came up. So question from Clear Angel. What has been the reaction so far from founders about the 4-year time horizon?
Yeah, no, it's something that we spent a lot of time thinking about, and we've tried different variations of it. I think what we realized is we can actually make a meaningful investment in companies and both in capital and time. If we can sort of recoup that investment over a longer time horizon, we can work with companies that are very early and put them on the playbook. I think many founders appreciate it because they know that it's not a sort of one and done. Hey, you're in for 3 months. It's a 3-month accelerator, and then you're out. They know that they've got a partner, but really the way to think about it is an alternative to equity, which is kind of forever, right? So it's certainly not comparing it to a 4-year sort of term loan or something. That's a long commitment for I think a lot of founders. But if you compare it to equity, then I think founders realize that it's actually probably much shorter than the typical sort of seed investment equity hold duration, and that's been one of the things. Oh, you're on. I think you're on mute there, Ashraf.
Apologies. I was saying we had another question come in,
Yeah.
Might as well take those.
I don't know. I think in certain cases we would compete for the same startups as YC and Techstars. But here's what I would love is Y Combinator and Techstars really focus on the businesses that are solving meaningful technical. They're working on, colonizing Mars, life extension, like clean energy, like things that where the path to near-term traction is a little bit less obvious, and but working through Y Combinator, getting that like hands-on coaching and the equity investment that's associated with it, I think like that's really, really good for the world, right? And so founders that are using that time to mitigate technical risk, I think a traditional sort of equity-based accelerator is 100% the right way that they would go through. For Clear Angel, it's really about businesses that can show repeatable growth, right? And if you can start at $1,000 a month MRR, and we can get you to 500,000, then it's I think that's really the objective, and those companies would probably do better preserving their equity that they would have given up and having a 4-year partner, and so that's maybe the area where we would compete. But to be honest, I mean, Y Combinator accepts 1% of the companies that apply, if not less, and we're trying to build it so that everybody, every online business, we'll have a program for. It's just it's more of the abundance sort of mentality than scarcity.
Yeah, and we have a strong partnership with both and Techstars as well. And so, I agree. It's additive, and I look at it as, again, access to excess capital at that early stage is critical, and I think they all have a role to play. So, spot on. I think we're being asked to wrap up, but Hassan asked a question, and Andrew, where do you think Clearco is headed in the next 5 years? Any big challenges coming up?
Yeah, I mean, I think the way I always answer this is like, I think that if we achieve our mission, then hopefully the world looks very different in the next 5 years, and there are many, many more Silicon Valleys around the world, and there's many people who can go and build their businesses with confidence wherever they are and solve the problems that they see. And so if we can lower the activation energy for founders to get started, then I think and increase the odds of success, then I think we will have really moved the needle for the world. There's certainly big challenges. I mean, I think building a global company is something that I haven't really done before. Managing teams in different time zones, managing culture in a remote multi-geography world. I think that's one of the biggest things. Our team are mostly founders, and are founders, future founders, former founders, entrepreneurial people, and that becomes chaotic as we're 320 people now, and it becomes chaotic as you get to hundreds or thousands of entrepreneurs who just want to run through walls and get stuff done, but you've got to sort of all coordinate them in pointing in the same direction. So that will certainly be something that we're already starting to feel. And we'll have to organize ourselves to be able to harness that entrepreneurial energy without driving ourselves crazy.
That's great. Well, and Andrew, I know that we're supposed to head out now. So I had my scruples about being a good interviewer, but you and Michelle make it really easy. It's just been a pleasure to get to know both of you. It's just amazing to see what you're building. I love being Silicon Valley Bank loves being a partner to Clearco. Congratulations on your last raise. Wishing you all the best and continued success, and just can't wait to continue to serve the market that needs that capital and is really, like I said, driving the economy forward. So just kudos to you and the team over there.
Appreciate it, Ashraf. Thanks for being such a great partner. We're excited to keep it going, but you were a fantastic interviewer. This is great.